Investor Markets. Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I'm Christopher Cahill, the host. Later on, we'll be speaking with two people, Jeff Kelley and John Drachman. Jeff Kelley is of Equity Institutional, which is an administrator and custodian for alternative assets. John Drachman is of Alpha Segment. But first, a few words from relevant recent writings. In the August 1st, 2015 Wall Street Journal, in the Word on the Street article, it's a regular feature by Ben Zimmer about cliches, there's a treatment of an oxygen cliche, that is, sucking all the oxygen out of a room, letting all the oxygen out of a room. He examines where that came from. Well, he finds that the word oxygen comes from the French oxygène and was coined by the chemist Antoine Laurent Lavoisier in 1787, shortly after the element's discovery. Lavoisier created the word from the Greek parts that literally mean acid-producing because he believed in a certain way that turned out not to be true of how oxygen forms acids. It took a while, but oxygen was later used more figuratively to refer to a sustaining force or essential energy, which is how we use it today. The Oxford English Dictionary records English poet Walter Savage Landor in the 1800s, stating that vanity and agitage are to a Parisian the oxygen and hydrogen of life. That's right, I said agitage. A-G-I-O-T-A-G-E. It's an English word that has fallen into disuse. Agitage means speculation on the movement of stock markets. So, I'm thinking maybe we should start a companion radio show called Agitage Radio, whereas Accredited Investor Markets Radio attempts to provide a more analytical framework for understanding investments. Agitage Radio could simply speculate on the movement of stock markets. On the other hand, maybe that particular niche has been filled by every other program on finance that one can name off the top of one's head. They're all about speculation on movements of the stock market. They're all forms of agitage radio. But one more note on oxygen as a reference to a sustaining force or essential energy. Oxygen was coined the same year that the U.S. Constitution was ratified in 1787. So with the discovery of oxygen, we were able to identify an essential force for our biological lives. And for partisans of the United States Constitution, 1787 also marked a formative force in the establishment of freedom in our lives. Speaking of politics, and we speak of politics lightly on our show, some weeks ago, in the context of a summary of crowdfunding projects published by Crowdster with a K, I noted that there was one project dedicated to replacing Andrew Jackson on the $20 bill with someone named Wilma Mankiller. And I admitted that I had never heard of Wilma Mankiller. Well, the great thing about having a World Wide Web at our fingertips is that you don't have to remain ignorant for long. And indeed, Ms. Mankiller has a very fascinating life story. At gos.sbc.edu, one can find a public address by Wilma Mankiller to Sweetbriar College in 1993. Now, since 1993, both Wilma Mankiller and Sweetbriar College have passed on, but the address was entitled Rebuilding the Cherokee Nation, of which Mankiller was the first female chief. That really is something when you think about it. Before she was a chief, Wilma Mankiller participated in a student occupation of Alcatraz Island in 1968. Yes, things like that happened back then. She was awarded the Medal of Freedom by President Clinton in 1998. Wilma Mankiller rose from poverty. She did go to college, but she didn't go to a highly credentialed college. And she was evidently quite fearless. And in her address to Sweetbriar College, she said the following, and she makes a reference in what I'm about to quote, to a relocation. The Cherokee were famously relocated from the southeastern United States to Oklahoma. But while living in Oklahoma, her family was further relocated. And what she says is, what I learned from my experience in living in my own community in Oklahoma before the relocation is that poor people have a much, much greater capacity for solving their own problems than most people give them credit. And as her address to Sweetbriar College winds to a close, she says of her people, we've always been acculturated to believe that the Bureau of Indian Affairs or the Indian Health Service or somebody else had better ideas for us than we ourselves had. And so trusting our own thinking, tearing that away from them and getting it back, I think, is the single most important task we have ahead of us. And we've started that. So I think, having looked at the issue, I can conclude that Wilma Mankiller was quite a Cherokee, quite a chief, and quite an American. Turning to wine, one of our sister sites to Accredited Investor Markets is Commercial Bankruptcy Investor, one of 3 commercial bankruptcy websites we offer, which are plain English treatments of bankruptcy and insolvency issues to inform investors as well as executives, non-specialist professionals, all can profit by reading these sites. Well, the article I would like to talk about today is the Sonoma Winery Files for Chapter 11 Bankruptcy Protection. It is up right now on Commercial Bankruptcy Investor. Wine. Now, a lot of us love wine. And maybe we'd like to invest in something we love, invest in a winery, invest in a winemaker. Well, I can tell you as a 17-year commercial bankruptcy attorney that I find that a good first step to understanding an industry is to examine the failures in an industry as they play out in bankruptcy court, because bankruptcy court requires everything to be made public. The kimono is open, in the undelicate phrase that bankruptcy attorneys use. So you can really begin to understand the economics of winemaking by looking at the failure of Sonoma Winery, how these entities work and how they can go awry. This is helpful to investors, I believe. And so this article is a good first step to understanding those things about winemaking. I'd like to make another note. One of the largest creditors in the case is the Francis Ford Coppola Winery, LLC. If you've been in a liquor store in recent years, you would have found Coppola wines. Well, Francis Ford Coppola, for our younger viewers, I know your listeners, not viewers, is Oscar-winning director of Godfather and Godfather Part 2. And that's not the limit of his accolades in Hollywood, his achievements. He also wrote the famous military pep talk that opens Patton, another Oscar winner. Now, the thing about Coppola, the director, is that he was infamously profligate with the money of the producers, perpetually over budget and by a great amount. They're the wild artist archetype who, what's money? Who cares about money? So there was a mismatch between the producers who are trying to shepherd investment in a film and the wild man at the controls as a director. So that his winery company, Francis Ford Coppola Winery LLC, is the biggest creditor in a fellow winery company's bankruptcy is quite a turnabout. Well, let's get to the interview. I have with me Jeff Kelley and John Drachman. Jeff Kelley has over 20 years of experience in financial services operations management and has been Chief Operating Officer of Equity Institutional since January 2008. Before that, he was a registered investment advisor with Academy Capital Management. And Jeff is also an Accredited Retirement Plan Consultant through the Society of Professional Administrators and Recordkeepers. Jeff earned his BBA in Finance Management from Baylor University, which, as everybody knows, is in Texas. John Drachman joins us also. He's with Alpha Segment, a group of marketing communications freelancers dedicated to meeting the marketing needs of registered investment advisors, asset managers, and financial services providers. John is a frequent contributor to industry publications on topics related to financial technology, trends, crowdfunding, and alternative investments. I'm happy to say that John has contributed a two-part series to AccreditedInvestorMarkets.com, to which we're going to refer today. The title of the series is When Stocks Decline, Alternative Investments May Help. So let's get to the substance of this interview. Jeff, Mr. Kelley, Equity Institutional tells us on its website that it provides alternative investment custodial services to brokers, advisors, and sponsors. Well, that sounds interesting and important, but a little abstract. What are these services, and how and why do brokers, advisors, and sponsors use them?
Yes, in answer to your question, these services are primarily comprised on the operational side, and what I mean by that is there are varying numbers and types of alternative investments. These investments all have specific processes by which people obtain these investments and hold these investments. In a retirement account, specifically an individual retirement account, it is required by the Internal Revenue Code that the IRA have a trustee or a custodian. So our role here at Equity Institutional as that custodian is to help brokers and advisors navigate this landscape of the varying documents required for all of the types of alternative investments to take these into their IRAs and hold them as a true retirement asset for the long term.
So the certificates and or whatever it stands for certificates in the web world are in your custody.
It's correct. Many of the investments are represented, for example, limited partnerships would be represented by a subscription agreement. Some of the investments, such as precious metals, are actual hard assets. In each case, these documents or assets that are required to be held by a custodian, we will either help the broker advisor execute the documents properly so as to maintain the qualification of the IRA, or help the broker or advisor take possession of the physical metals, in the case of metals, through a depository we use in Delaware.
Oh, okay. I was kind of hoping the physical metals would be located in a mountain that was invulnerable to bunker-busting bombs, but they're just someplace in Delaware.
Well, they are held in a very secure facility, the largest in the nation, and they are definitely subject to the strictest of security requirements, so they are very much safe and sound when they're in possession of Equity Trust.
Of course. So when the brokers or the investment advisors, or for that matter, traders, are moving stuff around on computer screens, the actual stuff, of course, to be legally defensible, to be something that can be exchanged for actual money, must be somewhere, at least legally speaking, and you account for where it is.
That's exactly right. These assets, whether they be hard assets or true investments represented by paper documents, these are not only titled in the name of Equity Trust, but held and maintained by Equity Trust for the benefit of the account holder.
All right. Well, whenever I speak with somebody who holds precious minerals or precious metals, I always want to know the answer to the following question, and John, please weigh in. How might a customer gain from having an Equity Institutional physically hold precious metals as part of his asset allocation for his portfolio, compared with simply going to a broker and betting on price swings by purchasing precious metals futures or something? How is that, from an investment point of view, better?
Yes, so as we're speaking with our providers, precious metals brokers, professionals in the industry, we hear a lot on that topic. And, you know, one of the things we hear repetitively is there's no expiration date on the physical metal. In other words, these investors who are taking advantage of this opportunity allowable under the Internal Revenue Code to hold these in a retirement account by investing in the physical metal, they have an unlimited holding period, and they tell us they still may be subject to the swings in any market, just like in any publicly traded security. They do take comfort in the fact that they actually hold the physical metal, and if they want to hold the physical metal 100 years from now and pass it down, it is still there, and it is still the hard asset in the same condition as which they bought it. So it is less of a short-term play, in their words, and more of a long-term opportunity for an appreciating asset.
Okay, so a given precious metal-related security, such as a futures, might, number one, depending upon the security, not be something you could put into a qualified retirement account, or it's something you could hold in a qualified retirement account only for a period of time. Is that it?
That's correct. If you are truly looking for a long-term hold, the physical piece is always the piece that you can count on over the extended period. And like you asked in your question, once you clear the hurdle of what typical type of future or contract you can hold in a retirement account, once you get over that regulatory hurdle and they know, for example, a contract would be allowable in a retirement account and there is no leverage, you still run into the issue of an expiration date on some of these potential contracts, and it's really betting on short-term movements, right, in the words of our providers, as opposed to a long-term hold strategy.
And there are schools of thought about this which suggest that you should have a certain amount of precious metals if you do, but not as a short-term way to make a profit, but rather as a long-term piece of a larger portfolio. Well, you, Jeff, offer expertise in alternative investments in connection with IRAs. And as we just were more or less saying, that very sentence, at least a few years ago, was very problematic. That is, how do you have alternative investments which qualify for IRAs? Well, where do you enter in the process of IRA construction, and what is it you exactly do?
Equity institutional is what would be referred to in the industry as a passive custodian. While we don't offer any advice on investments or make investment recommendations, we enter into the process early on specifically by providing education on the various types of alternatives that you can hold in an IRA account. We've been doing this for quite a long time, and we are very familiar with what you can and cannot do inside of your retirement account. And one of our primary roles is to make sure that anything that someone wants to do in a self-directed IRA does not disqualify that account or make it subject to taxation. Once you pass the investment decision process, the education on what you may or may not hold, and someone does do their due diligence and make a determination on what they would like to buy, in the world of alternative investments, if you took 5 different asset types side by side, there would be 5 different documents or groups of documents or processes by which you would actually make that investment. Most people really do not know where to start in our industry to make those investments. Having done this for years and doing it on a daily basis, we help our clients and their advisors smooth out this process of actually affecting the investment, and we walk them through the process of not just what specific documents are required, but also how those documents should be completed so that you're not learning by trial and error, because in this case the error could actually result in a tremendous penalty.
The communication between equity, institutional, and, let's say, an investment advisor that has some of the questions that you were just posing, is that always person to person, or do you have a kind of automated guidance that you offer investment advisors or others?
Well, we handle that really in 2 ways. We offer volumes of educational materials should an advisor be interested in doing their own research or walking through those materials and kind of taking a crash course on the alternatives investment industry. But honestly, most of the communication, most of the true upfront work is handled person to person, and we actually pride ourselves on the ability to either sit down with or spend time telephonically with these investment professionals and help them in the areas where they are not familiar, and that is truly the backroom operational step-by-step process to get them in the investment that they desire.
All right, well, I'm going to ask a two-parter, first to John and then I hope to Jeff. John, you wrote in Accredited Investor Markets at AIMkts.com about, well, the name of the article is When Stocks Decline, Alternative Investments May Help, two parts. And you write more broadly about stock movements and the movements of alternative investments, which made me think, especially since Mr. Kelley is from Texas, that oil and gas is severely distressed at this time, I think we could fairly say. So it's at a low. And there must be investors out there who are hoping to gain some upside down the road at some point. And I would think that maybe there are some people who have some space in their retirement portfolio to add oil and gas in such a way that maybe that upside will benefit them in their retirement accounts. Is what I'm saying cogent to you, John Drachman?
It's very clear and it's very accurate, Chris. And what we're seeing that when you look across the oil and gas industry, of course, you have all these different areas, some of which have been very much more affected by the decline in oil prices, and others, such as the oil rig area, that has really not taken much of a hit from the decline in oil prices because of the cost efficiency. So as you sort of look along the supply chain in the oil and energy area, what some alternative investment sponsors are doing are building out these master limited partnerships, which are bundling together in the form of publicly listed securities to trade much like a stock interest in these partnerships, not as corporations, but as actual partnerships. And so we're seeing a lot of increase in the MLP area in recent years, in part due to the attractiveness in still a lot of parts of the energy industry, but especially the fact that MLPs can generate a really attractive yield, which has a lot of appeal for retiring baby boomers especially. Pew Research did a piece about a year ago projecting that there are about 10,000 baby boomers a day that are now leaving the workforce and going into retirement. They have been very much hurt by the 2008-2009 global decline, which is one of the reasons they're looking into alternatives, the alternative area. They need higher yields. They can't take another major economic collapse to keep their resources whole as much as possible.
Well, then that raises the backroom question, which I direct to Jeff. John was talking about master limited partnerships, which are publicly listed securities. There must be other ways to hold oil and gas. What are the ways in which one can hold oil and gas and still have those holdings be part of a qualified retirement account?
There are many different ways as these markets begin to learn and understand the alternative investment industry. There is, quite frankly, a large acceptance out there of the master limited partnerships because of that publicly traded nature of the investment. But in addition to the master limited partnerships, you find that many of these investments also come in the private limited partnership form. Now, while these are primarily only offered to accredited investors, you are actually investing with a smaller group in a smaller production platform, maybe as little as one well or the exploration for one well. And that limited partnership structure is where equity institutional would come in that affecting that investment inside your IRA, there are specific documents that must be executed and specific titling that must be that the investment must be placed in. And that is really where you see kind of a divergence from the more publicly traded master limited partnerships to the true private LPs. And from what we're hearing in the industry, many advisors believe that the closer you get to the publicly traded arena, you tend to find the less correlation there. And that is why we're seeing more advisors move towards the truly private investments that are structured to invest in the oil and gas industry, but they are truly private limited partnerships with a limited number of investors.
And when you refer to correlation, you're talking about correlation to the larger public securities market? And
that is correct.
On the theory that if you wish to get the yield that Mr. Drachman was referring to, you want something with less correlation. Indeed, isn't that where commodities, and especially oil and gas, usually fit into a portfolio?
That is absolutely correct, and exactly what we're hearing from the financial professionals on the street who are looking to take that one step to move closer to the truly private alternative industry that is, while it may not be as liquid, it is certainly one of those investments that is less correlated to the true market movements.
Well, Jeff, then what is it as we have things like master limited partnerships become more important or more salient, they would say, in social science? Somebody somewhere must be deciding that these are kosher for retirement accounts and hence can be part of a qualified retirement account. Who makes that decision, and how quickly does the sphere of acceptable alternative assets evolve over time?
You are correct in your initial statement, and really that investment decision is made by the registered investment advisor or the broker or financial professional, however you would like to categorize it. And it's made based on their due diligence, and granted, alternative investments always require a bit of due diligence by the advisors and the investors. But what we are seeing is that as of several years ago, when these investments began to open up and be more accepted, both regulatorily and as a general acceptance in the market, we see that there is more of an interest to learn how they can take possession of these assets in an IRA, specifically from the operational standpoint. And there's not a large body of firms out there who are willing to walk through these processes when they have a public arm who can point and click on a security and purchase it. And that is one of the true benefits of working with an equity institutional.
Well, I was just reading about a new security, probably not new in form and maybe not particularly novel really, but peer-to-peer lending has become bigger and bigger and stands to get larger still. So these peer-to-peer lending outfits, which are alternative assets in and of themselves, the loans they deal with, are finding that their loans are getting securitized into pools and then purchased by the Goldman Sachs and others of the world. So it occurs to me, just sitting here, that these kinds of assets might find their way into your hands, Jeff. Do they present any kind of challenges? Are they new in any interesting ways to you?
They do find their ways into our hands, and they are rapidly becoming popular. And specifically the platforms we are seeing are the ones that do allow investors to make a purchase, which is almost a small pool of a piece of many loans. So it gives them comfort in diversification, but it acts like the much larger securitized packages that you do see the Goldman Sachs of the world buy. The one hurdle that we have seen in this industry that is rapidly being overcome is on the side of the state laws, because there are some states who, while they are publicly registered with the SEC but privately traded, have not taken the step to allow investors in their states make an investment in some of these peer-to-peer lending companies. But those states are dwindling rapidly, and we're seeing a true rapid acceptance of this type of investment. But it is relatively new still, and it is moving truly with the rest of the alternatives market to acceptability.
A particular security might be okay in one state and not in another. And is that something you vet? That is something you check to make sure that it is okay under the state securities laws before, as part of your process of taking custody and dotting all the I's and crossing all the T's of these particular holdings?
Actually, it is truly the lending platform that is the gatekeeper on that.
All right.
Because they are well-versed in the states in which they can and cannot do business. From the standpoint of equity institutional, we help prepare all the documents and prepare to make the investment, but during that preparation process is when we would learn from the platform whether or not the investment could be accepted. And then, of course, through repetition, we do know a lot of the states that will and will not accept those. So truly the gatekeeper is the platform, but we certainly aid in that.
Well, Jeff, you've been at this since before platforms had their current prominence. Is assets coming through offerings on platforms complicating your work, or is it just more of the same thing?
What we are finding is the platforms make it drastically easier because the investors that we see now that are going into these types of programs have historically been the same investors that would, in a peer-to-peer lending example, would be investing in individual notes one at a time, as opposed to making one investment that is truly in a pool of notes. So really from the standpoint of the platforms, they are an operational efficiency for equity institutional.
Well, I guess I should finish by taking note of what many see as a trend toward more holdings of alternative assets generally by accredited investors, as accredited investors really become more aware over time that they can do it and that they're not limited to the public securities. And if that's all true, that should lead to a whole lot more work for equity institutional as such assets find their way in particular into individual retirement accounts. Do you think that's fair to say?
I do believe that is fair to say, and what we are experiencing during this phase of acceptance and more widespread notoriety of true alternatives, we are seeing that we spend a great deal more time than historically we have had to with advisors and brokers who are new to the alternative space. They certainly understand the investment side, and we are there to help educate on the actual process of making the investment. So as the professionals make their determinations that this really is a trend, and by the way, we believe it is, we really are seeing a lot of opportunities for new relationships and truly walking people through how to make these investments. And in addition to that, we are learning a lot. All of our information and that helps us with our company direction comes from these new relationships with advisors and brokers, and we truly cherish that.
Well, I have this vision that the business you're in the years before you joined it was fairly unchanged, from the 1910s through almost the 1970s, when virtually all shares were certificated, for example, and that it's just been one change after another over the last generation. You think that's fair?
I think that is definitely a fair characterization, and I would take that one step further and say that even in the last 5 years, the business has become much more dynamic as opposed to 15, 20 years ago when it was really a everyday same thing because of the limited number of alternatives out there and the limited acceptance by the financial professional community.
Yeah. Well, all right. Jeff Kelley of Equity Institutional, thank you.
Thank you.
And Mr. John Drachman of Alpha Segment, we thank you as well.
Thank you too, Chris.
You've been listening to Accredited Investor Markets Radio. Our producer is Stephanie Strait. I am Christopher Cahill, your host, We thank you for listening, and let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.